let's look at some few complications or some few items that the standard also provide. The first one is reimbursement. Reimbursement simply means that sometimes the entity may recover the provisions. So if the entity may recover the provision, then this will create some form of income to the entity. But we can only do this when that provisions or that recovery is virtually certain. The only way we can account for reimbursement or recovering of a provision is only when the criteria of what virtually certain is probable. There is a virtually we can recover the amount with this certainty, and this certainty is what we call the virtually certain. And then we can also what measure, and it's probable that the recovery will actually be what be realized. That is only when we can account for what reimbursement. Now there are others too, that the other key items the standard also provide that we'll take them one by one and go through them. The first one we are going to look at is onerous contract. What is an onerous contract? So onerous contract. Onerous contract. When we say onerous contract, they are contracts that the unavoidable cost. Simply, we are saying that the unavoidable cost is greater than the economic benefit or the benefits to enjoy. The benefits to enjoy, or in simple terms, the unavoidable cost is greater than the benefit. But in the definition, we are saying onerous contract is a contract that the unavoidable cost in fulfilling or completing a contract exceed the benefit to be realized under that particular contract. What it means is that you have entered into a contract with an entity, and then there is one or two reasons you want to terminate the contract. But there are some costs that you cannot avoid even when you terminate that particular contract. And anytime those costs is bigger or greater than the benefit you are going to enjoy from the contract, then we say there is what? An onerous contract. And this creates an issue of what? Provisions. In basically, you can look at onerous contracts as a judgment debt. You are cancelling the contract, yet you are going to pay for what? For the costs. So that is it. For example, assuming we plan to sell, we contract with an entity to provide us with 200 units. 200 units of product for the next 2 years. The price that we are going to sell the unit is going to be $7,000. But just after six months, we want to terminate the contract because we realize that from 6 months going, the units are just being sold for $500. They are just being sold for $500. This has created an issue of what? Onerous contract, because the exact amount, which is 7,000, has reduced to 5,000. That means there is a loss or there is a decrease in what? In the value, the cost. This means that the cost is going to be greater. The amount that you are purchasing the item is going to be greater than the benefit you are going to realize at the end of the period. And if you want to get it, it's going to be the 200, which is the loss that we are incurring as a result of terminating the contract. We are terminating the contract, but we have already contracted the other entity, the supplier, to provide us for 2 years. So we can only terminate that contract totally after 2 years. So with the rest of the 1 year, 6 months, we are supposed to account for what we call provisions, which is what? The onerous contract. Because there is an unavoidable cost being greater than what? The benefit. The next item we are going to look at is the reconstruction I've been talking about from the inception of this particular lesson. Reconstruction basically is when we want to restructure the management body or the reorganization, the capital structure of the entity. And sometimes the expenses that you incur in restructuring the entity comes with some form of provision. You are supposed to provide for it. So this must be done in an appropriate term. The standard has outlined some key terms or some key principles that one must follow when accounting for construction or restructuring provisions, and we will not go deeper into that. Another one is loss from operating or future operating losses. So future operating losses, just like the onerous contract. So future operating losses. Remember that a provision must meet a criterion, which is what? Present obligation. But here we are saying future, operating losses. That has already violated that particular criterion. But in some instances, there is a probability that the business is going to incur losses from it operating or from operating for a series of what? Years or months. If there is probability there, it's probable with 50% and above probability that we are going to incur those losses, then it is very necessary to provide for provisions under the future operating losses. Another key item that the standard give explanation to is decommissioning costs. Decommissioning or dismantling cost has been accounted for under IAS 16, that is property, plant, and equipment. But the standard has also give a bit of explanation as to how we should account for a decommissioning cost. Sometimes, basically, industry that undertake manufacturing, they pollute the land. So at the end of the period, these entities are required to, restore the land to their previous condition or their previous state. If that happens, then there is a need to provide or make provisions for decommissioning costs, although it has been accounted for under IAS 16 as part of the cost of the item because it's a direct cost, so it's capitalized as part of the cost of the asset. And at the end of the useful life of that particular asset, you know that we are supposed to write them off in the books of the account. So if that happens, how do we account, or how does we provide for the decommissioning cost? This decommissioning cost is something that is going to be happening in the future. But once we have made plan for it, and it has been communicated to the right shareholders, then the entity is supposed to make provisions for it in the books of the entity. So, and the last key thing I'm going to talk about is future repairs. Future repairs. There are some times that you would like to undertake repairs of some assets in the entity, and there must be provisions for them because of what? A past event. And this, the standard has not given detailed explanation about them, but has just been mentioned, and we are supposed to also know what the standard talks about. So we will not go deeper into the repairs or the future repairs, but basically you are supposed to know that there are sometimes entities who undertake repairs of their assets, and then a provision must be made for them when they meet the three criteria. Alright, so having dealt with the first category of IAS 37, that is provisions, we want to now focus or turn our attention to the last two, which is contingent liabilities and then contingent assets. With the contingent liabilities or contingent assets, one thing you are supposed to note is that there's nothing like you recognizing them in the face or in the books of the entity or the financial statement of the entity. What we only do is that we disclose them in the notes or the notes to the financial statement of the entity at the end of the reporting period. Please, not at the end of the financial accounting period, but the reporting period. Now, what is contingent liabilities? Or what is contingent asset? Once you know what is the contingent liabilities, probably you'll transfer your knowledge to establish the understanding in the contingent assets. With the contingent liabilities, we are saying that they are possible liabilities. Remember, when it comes to provisions, we are not looking at possible, we are looking at probable. But when it comes to contingent liabilities, we are looking at what? Possible liabilities. And these possible liabilities also is happening as a result of what? Past events. But their existence, the existence of these particular possible liabilities must be confirmed by the occurrence or non-occurrence of uncertain future events which are not within the control of the entity. So basically, we are saying that contingent liabilities are possible liabilities resulting as a result, happening or occurring as a result of what? Past event, which existence can only be confirmed by the occurrence or non-occurrence of uncertain future event, uncertain future event, which are not within the control of the entity. Basically, what we are saying is that contingent liabilities are those liabilities that does not meet the provisions criteria. So anytime we are seeing an item which is not meeting the criteria provided for provisions, then we are saying that it is a contingent liability. Basically, when we say contingent liability, we are saying that they cannot be any reliable estimates, or we cannot measure them reliably, and also there will be nothing like an outflow of economic benefit from the entity. It's not probable. It's only possible. This is the difference. It's possible and it's not probable. So the difference between provisions and contingent liabilities is basically as a result of the provisions meeting the recognition criteria, that is the present obligation, probable that an outflow will be made, and then we cannot reliably measure them. But anytime there is these possible obligations are not meeting those criteria, these three criteria, then we are saying that they are contingent liabilities. Let's take a practical example. Assuming that A has sued B for damages. So A is the one suing B for damages. So at the end of the day, if A wins the lawsuit, then B is supposed to compensate A. In this case, the B is going to give money or compensate A. The compensation that B is providing to A, if it does not meet the provisions or the IAS recognition criteria, then we are saying that it is a contingent liability. Because there's nothing like a likely outflow of economic benefit. But in this case, the compensation A will receive becomes a contingent asset. So contingent assets and contingent liabilities have similar definition. But just that the contingent asset is a form of income which is supposed to be disclosed in the books of the entity, not recognized but disclosed. Remember that we only recognize provisions because they have met the recognition criteria. So there is a lawsuit, and this lawsuit, the lawyer of A's is saying that it's not likely that they are going to win the case. If it's not likely that they are going to win the case because of the future occurrence of that particular lawsuit, this does not give rise to provisions, but it gives rise to contingent liability, because there is nothing like probability. It's not probable that there will be an outflow of economic benefit from the entity's resources. So if that's the case, then you are going to give rise to contingent liabilities. So anytime you want to understand or you want to see or verify if a question is a contingent liability or provision, just establish that question or compare that question to the three recognition criteria provided by the IAS 37. Is there going to be a present obligation? If it's a present obligation, there probably is something that is going to be provisions. If there is going to be, it's probable that there is going to be an outflow of economic benefit, then that also is a provision, and we can reliably measure them, then it's a provision. But in the case where we cannot reliably measure our provisions, in a case where the probability is less than 50%, the standard says that when it is remote, and the standard does not give the explanation of remote, then we should not recognize but disclose contingent liabilities. Then also, when it comes to contingent assets, there should be a probability that there will be an inflow. Because it's a contingent asset, there should be a probability of an inflow. If there's a probability of an inflow, or it's probable that there will be an inflow of a contingent asset, then the entity can go ahead and then disclose it in the books of the account. So in trying to differentiate or know whether a question is a provision or a contingent liability or asset, the standard also prescribes what we call a decision tree to help us in establishing or in augmenting our understanding when it comes to the distinction between provisions and contingent liabilities. So I'm going to take you through the decision theory. So we have the decision theory, just to know if you are presented with a practical question, just to know whether this particular question is provision or is a contingent liability. So we have the start point to be somewhere here, and this start point leads to whether there is present obligation. So the first one is, I'll be using the initial, so present obligation. If the present obligation is yes, if it's yes, then is it having a probable? Is it probability, or is it probable that there will be an outflow of economic benefit? So the next, if it's yes, then we are going to look at whether it's probable that there will be what? Outflow of economic benefit. That is the next step. But if the answer is no, if it is no, then what are we looking at? Is there anything like a possible obligation? So if the answer is no, there is no present obligation, then there should be what? A possible obligation. Possible obligation. So that is this one as well. And again, if there is no possible obligation, then it will lead to something here. So let's wait. So we are just looking at the decision theory. Remember that the first one is start. Is there any present obligation? If yes, then is it probable that there will be an outflow of economic benefit? If no, is there any possible obligation? Now, let's come here. If it is probable that there will be an outflow, can we measure it? Yes. Can we measure it? Can this be reliably measured? So the next one is reliably measured. Reliably measured. So present obligation, yes. Is it probable that there will be an outflow of economic benefit? Yes. If it is yes, then it is reliable that we can measure it. Then what do we do? We account for what? Provisions. So the last result here is what? We are going to account. We account for provisions. Now let's look at if this present obligation does not create this one, but it's creating a present obligation. The present obligation is creating, possible obligation. Then if there is possible obligation, so there is yes here, does it lead to what we call remote obligation or remote possibility? Okay, so here we are looking at remote possibility. So if the answer is yes, then what we do is that we disclose contingent liability. We disclose contingent liability or contingent assets. So that's the final aspect over here too. And then if there is no possible obligation, then at the last place we do nothing. So here is do nothing. So this is about the decision theory to aid us in establishing between contingent liability and contingent asset and provisions. So the first point is there any present obligation? If the answer is yes, can we measure it? Is it probable that there will be an outflow of economic benefit? If the answer is yes, can we measure it? Then it leads to what? The account for provisions. But if there is no present obligation, but there is a possible obligation, yes. Is there any remote possibility? The answer is so yes, then we should what? Disclose contingent liability or contingent assets. So basically, this is about IAS 37. Remember that it has been split under 3 categories: provisions, contingent liabilities, and contingent assets. And under this, the provisions is treated separately because it's supposed to be recognized, where contingent liabilities and contingent assets are supposed to be disclosed in the note of the financial statement. Remember that a provision can only be recognized when they have met the recognition criteria, the 3 criteria established by the standard. And then at the end, you are supposed to disclose the relevant information, disclose the amount of provision the entity has made at the end of the reporting period, and any other relevant information that end users will need in making their decision. Thank you.